Ever wondered how banks, these giant financial institutions, actually make their money?
Yes, many times.
It's a question that often tickles our curiosity, isn't it?
It is.
We entrust banks with our hard-earned cash, but how do they turn that trust into tangible profit?
I don't know. You tell me.
Well, let's demystify this financial conundrum. Banks are not just high-security vaults for our salaries, savings, and spare change. They are, in fact, powerful engines that drive our economy forward. Like any other business, banks too need to make money to survive and thrive. But they do so in a way that's quite different from a typical store or service provider. Banks play a crucial role in the economic ecosystem by facilitating the flow of money. They act as a bridge, connecting those who have money to spare with those who need money to grow. This could be individuals, businesses, or even governments. But they're not just acting out of the goodness of their hearts. No, banks are savvy intermediaries, always seeking opportunities to generate profits. But how does this work in practice?
I don't know.
Well, imagine a colossal, intricate machine, continuously humming, never sleeping. This machine takes in deposits from one side and pumps out loans on the other. In the middle, it spins and churns, transforming those deposits into profitable ventures. This is the essence of banking. Now you might be thinking, wait a minute, I don't pay my bank to hold my money, so how are they making a profit? That's where the magic happens. Banks are masters of financial alchemy, turning your deposits into their profits through a mix of lending, investing, and charging fees. So, while we see banks as safekeepers of our money, they see our deposits as opportunities. Opportunities to lend, to invest, to earn. But they do all this while ensuring our money is safe and accessible when we need it, maintaining a delicate balance that keeps the economic wheel turning. So, the real question is, how do they turn your deposits into their profits? Stick around as we dive into the fascinating world of banking and unravel the magical money-making mechanisms that power these financial titans. Imagine you deposit $1,000 into your bank account, but does it just sit there gathering dust? Well, it's time for a little myth-busting. When you deposit money into your bank account, it doesn't just sit idly. It's more like a cog in a well-oiled machine, playing a crucial role in the bank's operations. Think of your deposit as a seed. Just as a seed has the potential to grow into a tree, your deposit has the potential to multiply and bear fruit. But how exactly does this happen? The answer lies in the concept of deposits. When you deposit money into your bank, you're essentially giving the bank permission to use that money. In return, the bank offers you a safe place to store your funds and, in many cases, a small amount of interest. Now here's where the magic happens. Banks don't just hold on to your money, they put it to work. They use these deposits to lend to other customers. That's right. Your $1,000 could be helping a small business owner expand their operations, or a family buy their dream home. This is not just a matter of generosity. Banks charge interest on these loans, which is often much higher than the interest they pay on deposits. This difference, known as the spread, is one of the ways banks make money. But it doesn't stop there. These loans, in turn, become deposits when the borrowers spend the money. And so, the cycle continues, with each deposit serving as a catalyst for more lending and more income for the bank. In other words, your deposits are the lifeblood of the bank's operations. They're not just sitting there gathering dust, they're actively fueling the economy, supporting businesses, and helping dreams come true. So the next time you make a deposit, remember,
I will always remember that.
you're not just saving, you're playing a part in a much larger financial symphony. So, how does the bank profit from your deposits? By entering the fascinating world of lending. Imagine you're a bank. You have depositors entrusting their money to you, and you pay them a small interest rate as a thank you. That's their reward for allowing you to hold their money. But here's the twist. You, as the bank, don't just sit on that money. No, you put it to work. You lend out the deposited money to borrowers. These could be individuals wanting to buy a house, businesses seeking to expand, or students needing to pay for their education. You charge these borrowers an interest rate for the luxury of using your money, but this rate is higher than what you're paying to your depositors. This difference in interest rates is the bank's secret sauce. It's called the interest rate spread. It's this spread that allows the bank to cover its costs, pay its employees, and ultimately generate a profit. The bank's ability to lend is not limitless, though. There are regulations in place that require the bank to keep a certain amount of money on hand, just in case depositors want to withdraw their money. This is called the reserve requirement. But outside of this, the bank is free to lend. And in doing so, it creates more money in the economy. Think of it like a cycle. Depositors put money in the bank lends that money out, borrowers spend that money, which eventually ends up back in the bank, and the cycle continues. This is known as the money multiplier effect, and it's a core component of our economy's function. But remember, the bank is not a charity. It's a business, and like any business, it needs to make money to survive and grow. And one of the main ways it does this is by lending money and charging interest. So, when you borrow from the bank, you're essentially paying for its services. Scene script. Interests, they're not just something you pay, they're the bread and butter of banking business. Let's imagine a world without interest. Sounds great, right? But then, why would banks lend out money? They wouldn't. That's where interests come in. They're the incentive for banks to lend out money and the cost for borrowers to use that money. So, what exactly is interest? It's a percentage of the loan amount or principal that banks charge borrowers for the privilege of using their money. In essence, it's a rental fee for money. The higher the interest rate, the more money you'll need to pay back. Now you might be wondering how interest rates are calculated. There are two main types of interest, simple and compound. Simple interest is calculated only on the principal amount, while compound interest is calculated on both the principal and the accumulated interest. Let's break this down. If you borrowed $1,000 at a simple interest rate of 5% per year, you would owe $50 in interest after 1 year. But if that interest was compounded annually, you would owe $52.50 because the interest is calculated on the initial $1,000 plus the $50 of interest accumulated. The interest rate isn't just pulled out of thin air. It's influenced by a variety of factors, including the current state of the economy, the creditworthiness of the borrower, and the length of the loan. The riskier the loan, the higher the interest rate. In the world of banking, interests are a crucial tool. They not only compensate banks for the risk and potential loss of lending money, but they also generate profits. Even a small interest rate can yield significant returns over time, thanks to the power of compounding. In essence, interests are the price you pay for borrowing money. They might feel like a burden, but without them, the banking system as we know it wouldn't exist. So the next time you're faced with an interest payment, remember it's not just a fee, it's the lifeblood of the banking business. But interests aren't the only source of income for banks. Welcome to the world of fees and commissions. Now let's delve into the realm of fees and commissions, another significant revenue stream for banks. These are charges that banks levy for providing various services, and they come in many forms. First off, we have account fees. These are charges that banks impose for maintaining your account. It's like a subscription fee for a gym or a streaming service. You may notice a monthly or annual charge simply for having an account with the bank. Some banks may waive this fee if you maintain a certain minimum balance. Next up are ATM fees. Ever notice that sometimes when you withdraw cash from an ATM that doesn't belong to your bank, you're charged a fee? That's an ATM fee. Banks charge this fee because you're using their infrastructure and it costs money to maintain ATMs. Then we have transaction fees. These are charges that banks impose every time you make a certain type of transaction. This could be for wire transfers, overdrafts, or even when you use your debit card abroad. Essentially, whenever you're using the bank's services beyond the basic account maintenance, you may be charged a transaction fee. Overdraft fees are another common type of fee. If you spend more money than you have in your account, the bank covers the difference and charges you an overdraft fee for this service. It's like the bank is giving you a mini loan, and the overdraft fee is the interest on that loan. Lastly, we have commission fees. These are typically charged when you use the bank's services to buy or sell stocks, bonds, or other securities. It's like a service charge for the bank helping you make these transactions. So there you have it. These are just a few examples of the types of fees and commissions that banks charge. Remember, these charges are not just for making money. They also help cover the costs of providing these services. So, every time you use a bank service, you're contributing to its revenue. Banks aren't just about deposits and loans, they're also big players in the investment game. Let's imagine for a moment a world of opportunities, brimming with potential for growth and profit. That's the world of investments and securities, a world where banks are just as involved as any other investor. Banks invest in a wide array of securities such as bonds, stocks, and government securities. These investments allow them to earn a return, further boosting their income. Now you might wonder, how do banks decide where to invest? Well, it's a bit like a chess game requiring strategic planning and a keen understanding of the market. Banks have teams of analysts who study the market trends, evaluate potential investments, and make educated predictions about future performances. But, just like any game, investing comes with its fair share of risks. The value of investments can fluctuate, sometimes dramatically, and there's always the possibility of losing money. That's why banks diversify their investment portfolio. By spreading their investments across a variety of securities, they can balance out the risks and potential returns. Additionally, banks have to comply with certain regulations meant to ensure they don't take on excessive risk. These regulations require banks to maintain a certain level of capital compared to their investments. This is to ensure they have enough cushion to absorb potential losses from their investment activities. And don't forget, banks also play a critical role in the securities markets. They underwrite securities, which means they agree to buy all the shares or bonds from a company that's issuing them and then sell those securities to other investors. This service not only helps businesses raise funds but also adds another source of income for the banks. So you see, banks are much more than just a place to deposit your paycheck or get a loan. They're also active players in the investment world, navigating the complexities of the securities market, all while managing risks and striving for profits. Thus, banks are not just lenders and service providers, they're also investors. So, we've seen how banks earn from interests, fees, and investments, but how do they ensure profits? Well, let's dive into the banking profit model. The secret to a bank's profitability lies in its ability to manage its assets and liabilities effectively. What do we mean by assets and liabilities? In the simplest terms, assets are what a bank owns or has a claim on, like loans and investments. Liabilities, on the other hand, are what the bank owes, such as deposits. Now, the trick to banking profitability is to ensure that the return on assets, or ROA, is greater than the cost of liabilities. Banks must strive to maximize their ROA while minimizing the cost of their liabilities. That's the key to the banking profit model. How do they do this? Let's take a look. Banks can increase their ROA by lending at higher interest rates and investing in profitable ventures. They might also charge fees for services and products, as we've discussed in earlier scenes. On the flip side, banks can decrease the cost of their liabilities by paying lower interest rates on deposits, for instance. But they must be careful not to discourage customers from depositing their money, as deposits are a crucial source of funds for banks. It's all about balance. Banks must carefully manage their assets and liabilities to keep the money flowing and their profits growing. They must constantly evaluate the risk and return of their assets and the cost of their liabilities. So, next time you walk into a bank, remember that behind the scenes, there's a complex interplay of assets and liabilities, of risk and return, all orchestrated to ensure that the bank makes more money than it loses. In essence, successful banking is all about smart money management. So we've unraveled the mystery of how banks make money. But let's wrap it all up. Banks, these massive financial institutions, operate much like a magician performing a spellbinding trick. They take the ordinary and transform it into the extraordinary. Let's start with deposits. When we deposit our money into a bank, we're not just stashing it away for safekeeping. We're giving banks the fuel they need to power their financial engines. Our deposits become the bank's reserves, which they then use to make loans. Loans are the next part of the magic trick. Banks lend out the money we've deposited, and in return, they collect interest. This interest is a significant source of revenue for banks. So when you borrow money to buy a house or start a business, you're helping the bank generate profit. But the magic doesn't stop there. Banks also make money through fees and commissions. These are the charges we pay for various services, like maintaining an account, transferring money, or withdrawing cash from an ATM. It might not seem like much on an individual level, but when you consider the millions of customers a bank has, it all adds up. And then, there's the world of investments and securities. Banks invest in a variety of financial instruments, stocks, bonds, mutual funds, and more. The profits from these investments further boost their revenue. It's all part of the banking profit model, a delicate balancing act where banks must carefully manage their resources to maximize profitability while minimizing risk. So the next time you deposit your money or borrow from a bank, remember, you're part of the bank's money-making magic.